Namaskar to all the viewers across the country. I'm Sanjala Haldar, Assistant Director of Income Tax in the Directorate General of Administration and Taxpayer Services, Mayur Bhavan, Delhi. Welcome to another session from Samvad. In this Samvad series, today we bring to you discussion on the topic Pay as you earn. For this episode today, we have with us Srimati Garima Jain, Commissioner of Income Tax, ITA Division, Central Board of Direct Taxes, Department of Revenue, Ministry of Finance. Srimati Garima Jain is an officer of Indian Revenue Service of 1996 batch. She has done her post-graduation in sociology and has a degree in law. She has worked in varied capacities with the Income Tax Department in Gujarat, Delhi, Mumbai, and Lucknow. Presently, as the Commissioner of Income Tax, ITA Division, Central Board of Direct Taxes, she is looking after the policy matters and administrative matters related to the implementation of Income Tax Act 1961. Ma'am, thank you so much for accepting our invitation for this episode of Samvad on the topic Pay as you earn.
Thank you, Sanjala. Namaskar to all the viewers across the country. It is indeed a pleasure and privilege to join Samvad, which provides a platform for positive discourse to share one's understanding of principles and provisions that would be useful for the tax holders and our valued taxpayers.
Ma'am, the pay as you earn concept is prevalent in many tax jurisdictions. It was first introduced for the salaried class to improve the tax base and revenue collection in the country. It was then implemented for the employers who would deduct the tax from the employees before paying them. The pay as you earn concept has been adopted by many tax jurisdictions like Ireland, New Zealand, United States, and Australia in various modified versions. Ma'am, could you please explain to us the concept of pay as you earn in the Indian scenario?
Yes, Sanjala. Insofar as India is concerned, we do not have any such specific scheme titled pay as you earn. However, the broad principle of pay as you earn has been incorporated in the Income Tax Act 1961 in the form of advance tax, tax deduction at source, and tax collection at source. These three forms of tax collection, that is advance tax, tax deducted at source, and tax collection at source, contribute for nearly 87% of the total gross revenue collection of India. Pay as you earn concept is a win-win concept both for the taxpayer as well as the government. As per this concept, the tax liability on the income earned during the financial year can be discharged by the taxpayers in small installments throughout the financial year, and the taxpayers do not have to pay the whole tax at one go once the financial year ends. Thus, the incidence of tax is distributed over the year. At the same time, the government is also able to mobilize revenues in a sustained manner throughout the financial year for execution of the various development activities. As such, the government receives a regular flow of revenue throughout the year so that expenditure can be made rather than receiving all tax payments at the end of the year.
Ma'am, you have rightly said that pay as you earn concept is a win-win formula. Timely payment of taxes by the citizens help the government to execute various policies. Ma'am, as you have mentioned that advance tax and tax deducted at source are the main modes of pay as you earn concept in India. Going further, could you please explain the various provisions related to advance tax payment?
Definitely, Sanjala. As is evident from the term advance tax, it is the tax to be paid in advance for the income of a particular year. Payment of advance tax is a statutory liability for the taxpayers under the Income Tax Act. Sections 207 to 219 of the Act cover the liability for payment of advance tax within the specified time limit. As per the provisions of Section 207 of the Income Tax Act, every assessee shall estimate income and tax liability for any previous year, and the income tax so estimated shall be paid in advance in accordance with the manner given under Section 211 of the Income Tax Act. A person shall be liable to pay advance tax only if tax liability is rupees 10,000 or more. That is, a person is exempt from payment of advance tax if the tax liability is less than rupees 10,000. Further, a resident individual of the age of 60 years or more at any time during the financial year who does not have income under the head business or profession is also exempt from the payment of advance tax.
Thank you, ma'am. Ma'am, as you have mentioned that there is a liability to pay advance tax if the total tax liability during the financial year exceeds rupees 10,000 with the exclusion for senior citizens. Ma'am, can you please explain how such advance tax liability is to be discharged?
Well, Sanjula, for the payment of advance tax, the Income Tax Act 1961 provides for 4 installments. The same are there in Section 211 of the Act. Not less than 15% of the advance tax has to be paid on or before 15th June. This is the first installment. Then not less than 45% of advance tax after reducing the previous installment paid, if any, has to be paid on or before 15th September. That would be the second installment. Then not less than 75% of the advance tax after reducing the previous installments paid, if any, has to be paid on or before 15th December. This is the third installment of advance tax. And finally, the whole amount of advance tax after reducing the previous installments paid, if any, has to be paid on or before 15th March. I will explain to you for ease of understanding by way of a simple example. So suppose the tax liability of the assessee is rupees 1 lakh for the year. So in the first installment, the taxpayer has to pay not less than 15% of the tax liability. So he is required to pay 15,000 on or before 15th June. Then for the second installment, he has to pay not less than 45% of the tax liability. So that comes to 45,000, but he has already paid 15,000. So for the second installment, he is required to pay 30,000, and this payment has to be made on or before 15th of September. Now comes the third installment, which shall not be less than 75% of the tax liability. That comes to 75,000. The assessee has already paid 45,000, so that is reduced from 75,000. For the third installment, therefore, he has to pay 30,000, and that has to be paid on or before 15th of December. Finally, the fourth installment, the total tax liability is 1 lakh, the whole amount of tax. He has already paid 75,000, so the balance amount of 25,000 has to be paid in the final installment. So, and these provisions are there in Section 211 that may be referred to. There is a special provision for small businesses and professionals who are declaring their income as per the presumptive taxation provisions of Section 44 AD and Section 44 ADA. The presumptive taxation provisions provide relief to such taxpayers with regard to non-maintenance of books of accounts in respect of eligible business or profession, as the case may be, and the taxability of income at a flat rate on the gross receipts or turnover from the eligible business or profession. The taxpayers who have opted for presumptive taxation provisions, they shall pay advance tax in single installment by 15th March to the extent of the whole amount of tax payable by them. Further, any amount paid by way of advance tax on or before 31st day of March shall also be treated as advance tax paid during the financial year, ending on that date for all purposes of this Act.
Thank you, ma'am. Ma'am, many taxpayers might be having a query as to whether TDS deducted or TCS collected can be reduced for the purpose of advance tax liability. Could you clarify this, ma'am?
Yes, Sanjula. Advance tax can be estimated by the taxpayer on the current income at the rates in force during the financial year. From the tax so computed, tax deducted or collected at source can be reduced and the balance tax payable will be used to compute the advance tax liability.
Thank you, ma'am. Ma'am, could you please explain a little bit about the mode of advance tax payment?
Of course, Sanjula. The process of payment of taxes has been made simpler. Advance tax can be paid online by visiting the website https://www.tin-nsdl.com, paid electronically through internet banking facility of the authorized bank or credit or debit cards. For companies and persons who are required to get their books of accounts audited under Section 44AB, it is mandatory to pay taxes electronically as per Rule 125 of the Income Tax Rules. Any other taxpayer can pay tax either by electronic mode or by physical mode, that is, by depositing the challan at the receiving bank.
Ma'am, you have explained about advance tax payment and modes of advance tax and various installment dates. Ma'am, suppose there is a taxpayer who has failed to discharge his advance tax liability as per the Income Tax Act 1961, then how can he discharge his liability, and if there are any consequences for short payment or late payment of advance tax?
Sanjula, good question. This is an important aspect to be discussed. As per the provisions of the Income Tax Act, the assessee is required to pay interest for non-payment or late payment of advance tax, as also if the advance tax paid is less than the installment due. If the taxpayer has failed to pay advance tax, or where the advance tax paid by the taxpayer is less than 90% of the assessed tax, the taxpayer is liable to pay interest as per Section 234B of the Act. Interest under Section 234B is levied at 1% per month or part of a month on the amount of unpaid advance tax. Similarly, there is a provision for levy of interest under Section 234C in case of deferment of advance tax beyond the due dates. It is charged at 1% per month or part of a month on the short payment of installment of advance tax. Unpaid advance tax liability can be paid after the end of the previous year as self-assessment tax at the time of filing of return along with interest.
Thank you, ma'am. You have explained in detail about the various provisions of advance tax, which is a part of the pay-as-you-earn concept. The pay-as-you-earn philosophy is deeply entrenched in how the Central Board of Direct Taxes administers direct taxes. It is also crucial for garnering of resources for the government. With this, we come to the end of today's session of pay-as-you-earn concept with a focus on advance tax. In the next session, we will know the pay-as-you-earn concept with a focus on TDS and TCS. Do follow us on our social media handles on Facebook, Instagram, Twitter, LinkedIn, and YouTube. Keep watching for more updates on informative content. Until the next time from Samvad, thank you and Jai Hind.